Welcome. Today, I'm going to be going over the Dando Investor book. You know Monish? He is a wealthy billionaire investor, and he laid down all his strategies, his formulas, his mental models in this book. So if you want to understand how he thinks, how he works, and how he approaches investing, then I highly suggest that you pay full attention. Make sure you have your paper and pen ready because I'm going to be dropping a lot of amazing golden nuggets. And if you don't know, Dando is a word from India that literally means endeavors that create wealth. Forget everything you've been taught about taking massive risk to get massive returns. The Dando way flips the concept entirely. It's about minimizing risk while maximizing the reward. It's a method so effective, it turned impoverished refugees into owners of over half the motels in United States. This is the exact playbook. The practical strategies and insights to make the perfect investment bet, which is, do you know what it is? Heads, I win. Tails, I don't lose much. So let's get started. So the core philosophy, low risk, high return bet. The Dando philosophy is pure, actionable genius. It's all about placing low risk bets that have a high chance of an extreme payoff. The power of margin of safety. The entire game hinges on buying assets for much less than they truly worth. This massive gap between the price and value is called the margin of safety. Legendary investor Benjamin Graham taught us that the margin of safety makes it unnecessary to accurately predict the future. If you buy a business for half what it's worth, even if the future goes worse than expected, the risk of permanently losing your capital is extremely low. So the takeaway, the golden nugget is always ask, am I buying this business for way less than I think it is conservatively worth? Aim for a discount of 50% or more to the underlying intrinsic value. Number 2, investor's edge. Dealing with uncertainty. Wall Street often confuses risk, the chance of permanent loss, with uncertainty, which is the wide range of possible outcomes. The best Dando opportunities appear when there is low risk but high uncertainty. When uncertainty clouds a business future, Wall Street panics and collapses the stock price. Now, the actionable wisdom is high uncertainty leads to severely depressed prices. If you can confirm the low risk, minimal downside, but see massive upside potential due to temporary uncertainty, that's your chance for a heads I win, tails I don't lose much bet. Now, there are 9 pillars of the Dando framework. Now, this framework is the detailed roadmap used by great investors and entrepreneurs alike, from Patel motel owners to billionaire like Lakshmi Mittal. So, the first pillar, buy existing businesses. Don't start from scratch. Starting a new venture is inherently riskier than buying an existing one. Existing businesses have a long history of operations and a well-defined business model that you can analyze. Pillar number 2, buy simple businesses in industries with ultra slow change. Complexity is the enemy of the investor. Stick to businesses that are easy to understand. Ones where you can make conservative assumption about the future cash flows. Look for industries that don't change fast, like hospitality, healthcare, because people will always need bed and people are going to get sick. Pillar number 3, buy distressed businesses in distressed industries. The best time to buy is when others are terrified. Warren Buffett advises to be greedy when others are fearful. Look for entire industries like motels after a recession or steel mills drowning in debt, where assets are being sold at steep discounts. The entrance strategy is more important than the exit strategy. Pillar number 4, buy businesses with a durable competitive advantage, aka the moat. A durable moat is what protects your high profits from being attacked by competitors. This moat could be low cost, like Papa Patel running a motel cheaper than anyone else, or Geico avoiding agent fees. Another moat would be brand strength, like Coca-Cola or Chipotle. Remember, no moat lasts forever, so you must always determine the durability of that advantage. Pillar number 5, few bets, big bets, infrequent bets. Outstanding opportunities are rare, so when one appears, bet heavily. This is the concentration strategy. There is a formula called the Kelly formula, and this formula suggests the optimal amount of your money to bet when the odds are overwhelmingly in your favor. Great investors think probabilistically, waiting patient for the perfect pitch. And there's a website if you want to use the Kelly formula. Now, the takeaway is if you understand what you own, you don't need to own very many things. Holding 5 to 10 diverse, well understood value stocks is enough to beat the market. Mutual funds often fail because they held too many positions, watering down their best ideas. Pillar number 6, fixate on arbitrage. Arbitrage involves exploiting price differences for virtually risk-free returns. Dando arbitrage involves an enduring spread that lasts years and yield supernormal profits with very little risk. So here, an example would be an entrepreneur addresses an offering gap like Geico selling insurance without expensive agents. The cost advantage acts as a persistent arbitrage spread, earning profits for decades. Pillar number 7, margin of safety. Always, this is important, it bears repeating, buy assets at a big discount to their underlying intrinsic value. The bigger the discount, the lower the risk and the higher the potential return. This is your protection against an unpredictable future. Pillar number 8, invest in low risk, high uncertainty businesses. Seek out opportunities where temporary negative news or market fears have driven prices down, but the underlying business model is sound. Now, pillar number 9, the last pillar. It's better to be a copycat than an innovator. Innovation is unpredictable. Great businesses often succeed by waiting for others to prove an idea, then lifting and scaling that proven model with better execution. So an example of a copycat is McDonald's often copied successful products like the Big Mac or drive-thrus from its franchisees or competitors. Microsoft built its empire by copying proven ideas like the graphical user interface, which is the GUI, and then scaling them massively. Now we're going to move on to the next segment, which is the hunting for the 50-cent dollars. This is very tactical, all right? So the market is run by Mr. Market, a moody character who swings wildly between extreme fear and extreme greed. We exploit these mood swings to find businesses priced far below their intrinsic value. So you're probably wondering, where are the best place to hunt this? Well, the magic formula. This is an index on steroids. It sorts all stocks based on two simple factors: return on invested capital, a measure of business quality, and price to earning ratio, a measure of cheapness. Invest mechanically in 25 to 35 stocks generated by this method to remove human emotion. Value Investors Club, VIC, a free website where approved value investors post their ideas. I just actually made a post there. So let's see if you can find me. Value Line, 52-week lows. Scan list that shows distress stocks with the lowest PE ratios, widest discount to book value, or those that have dropped the most in the last 13 weeks. Now, track the masters. Look at public filings like the SEC Form 13F on NASDAQ.com to see what the super investors are buying. Now, we have to focus on the execution. And once a potential investment jumps at you, become intensely focused, like the warrior who only saw the eye of the fish he was aiming for. Shout out all the other noise and opportunities until you have either rejected the idea or confirmed that it fits every Dando filter. Remember, focus. Now, we're going to be covering a very important part, which is the art of selling, when to exit. Buying is the easy part. Selling is the hard part. You must have a clear exit plan before you ever buy a stock. So, here's the rule for selling winners. If your investment has run up and the gap between the market price and the business intrinsic value narrows to under 10%, it is time to sell and look for a new, cheaper opportunity. You should definitely sell if the market price exceeds your estimate of intrinsic value. So the rule for selling losers: when a stock you own drops dramatically, the fear feels like a roaring sound, making you want to panic and sell. This is exactly when most investors fail. To avoid permanent loss, do not sell a stock at a loss within 2 or 3 years of buying it, unless you can prove with certainty that this current intrinsic value is actually lower than the market price. The 2 to 3 year wait gives you the business time to adapt, for the clouds of uncertainty to lift, and for market rationality to return. And if after 3 years the stock is still underwater, you must take the loss. Waiting endlessly beyond 3 years costs you the opportunity to reinvest the capital elsewhere in a high conviction Dando bet. Now, your conclusion, your action plan. Becoming a great investor is not about complex math or insider tips. It's about discipline and applying timeless, simple principles. Focus on the fundamentals. Your ultimate action plan, because I want to give you practical lessons and practical action steps. I want you to get value from this podcast, this episode. So here's the simple takeaway for you. Be a student of the Dando framework. Memorize the 9 pillars. Remember at the beginning of the podcast, I invited you to have a pen and a paper so you can take notes. And I hope you took notes. If you need to go back and listen to this again, listen to it, because you need to memorize the 9 pillars. Those are very, very important. Hunt for low risk and high uncertainty situations using the scanning tools that I mentioned earlier. Now, after that, you bet heavily and infrequently. When the odds are overwhelmingly in your favor, and that's when you bet. The next step would be adhere strictly to the 2 to 3 year rule for losers to avoid panicking when Mr. Market screams fire. And never forget rule number 1. Which, do you know Warren Buffett's rule number 1? Say it with me. Never lose money. Let's say that again. Never lose money. So by embracing the Dando framework, you will be making wealth creating endeavors while taking virtually no risk. That is the true definition of a great investor. If you haven't already, subscribe, share, and see you on the next pod. Peace.